So now we have identified one of these companies. Let's say, I don't know, Aena or Rolls-Royce or Microsoft. How do you value these companies? What is your valuation tool?
We don't even look at that until we get comfortable that the barriers are so strong it will be around. Now,
okay,
that's
so
not,
now big barriers, big
fine,
moats.
fine. So
we think it will be around.
Yeah, we think it'll be around.
We think there will continue to be an airport in Madrid.
Right. We'll do reference checks on relevant people. Okay. So, and see if we're missing something. So when we were looking at investing in aircraft engines, we spoke to the CEO of a former CEO of one of the competitive companies, and he confirmed our thesis and actually said the margins should be much, much higher. Okay, and over time they will go there. So that's one of the pieces of diligence. We will assess management, where I think it's important, but not critical if you have the right assets. Ideally through meeting them. Talk to competitors, get their view, and look at competitive companies, look at the track record of the company, and usually you don't understand everything, and usually the things you find out are bad things, and I think we'll discuss it with our team, and we want to hear competing views. Yeah, we have some members of our team who are just inherently bearish, and they're good for testing the bear case. We always want to hear how could technology disrupt, and or just what competition and.
Are you a bearish guy?
Not particularly. No, I've
What kind of valuation metrics do you look at? P's, cash flows? Do you do DCFs? Do you have like 50-page spreadsheets?
All of those,
right?
All of those, but not 50 pages. You know, that's but really, honestly, one of the things we learned is, and there's a really important point, is that we can have an advantage through long-termism. Okay, which is the average stock is held by an institutional investor by under a year, or the stock market in the US.
How long do you hold it?
Our average holding period of our current portfolio is 8 years.
8 years.
Yeah, 8 years. I'm not saying that's the limit. It's just we've on average, some we've held for 13 years, some new investments like GE Aerospace 2 years, but the weighted average holding period is 8 years. Yep. So, but it could be 10, it could be 20.
Yeah, no. I love long term, right? But how do you install that type of thinking into your organization? I mean, you're straight out of business school. You're straight out of business school. You want to, hey, I mean, went to Harvard like you did or whatever. It's just like, hey, let's do some stuff. Come on, let's do some stuff.
Yeah.
And it's just like, hey, okay, let's buy something and hold it for 8 years. Right? You come home to your partner every day. It's just like they do nothing. They just sit there and own for 8 years.
Really, if you are in the private equity world, that's normal. Yep. A private equity fund would hold an investment for their 10-year life funds normally, or longer, 12 years, as you know. And so we it's an overused expression for some, or misused. We take a private equity approach, i.e. that we have to hold the company forever. Because the stock market may be at very bad prices when you want to sell, if you need to sell, and so I really think you need to have that approach, and so the way we really like our long-term valuations, DCF, the most important things, and here's the thing.
DCF, you take the cash flow and you discount it back to today.
Yeah. But here's the thing: is the longer you can look out, if you've got a great company, the more value there is. Take a company we own, Moody's. Moody's,
a rating agency.
So it's been around 100 years. What do you think the average I can ask you a question, make it fun. What do you think the average revenue growth over that 100 years has been?
I'm going to look like a total fool, but
100 years is a long time.
7%.
10.
Wow.
Yeah, so it's a very unusual number over a very long time period. And so investors have always underestimated its value, including myself. Yeah. And I bought the stock during the financial crisis at 10 times earnings, and I even bought shares Warren Buffett was selling, and he reduced his stake from 25% to, I think he's got 15%, and Berkshire. And
Are you kind of secretly pleased having bought something cheap from Warren Buffett?
Yeah, but then I sold it. I doubled my money. I went from 10 times earnings to 20, and I sold it at $100. Bought it at 50, sold it at 100. I thought I was clever, but the earnings kept compounding.
So did you buy back?
I bought it back at $150, so now it's recently $500, now $400. So it's because actually the intrinsic value compounding matters more than the stock price. If you have a great company, it will grow intrinsic value.
Absolutely.
And the multiple, here's the thing about the multiples, they matter less than the growth when you look at it over a longer period. But most investors are unwilling or unable to invest on a long-term time horizon because either they don't know what they're doing, which interestingly goes back to what they think it's risky, which goes back to what Warren Buffett was when he was asked what the definition of risk was. You know what he said? Not knowing what you're doing.
So really good nugget here is that if you buy something which is really good, it doesn't quite matter what you pay for it because it will grow.
Secondary over a long, let's just say it like this, the multiple to a point, whether you buy it at, if it's growing, it's all maths. Yep, you've got to look at the growth rate, the terminal multiple, all the multiple things. But if it's increasing intrinsic value at a good rate, you will undervalue it if you look at it over a short horizon. Yep, I can be saying it like that. And if you're willing to hold it for a long term and extract that intrinsic value growth, it'll be worth more to you than other people.